The market is currently screaming at you, demanding action. It offers the high-octane thrill of option gambling on a digital coin that promises 10,000% returns overnight. It serves up the intoxicating, socially amplified drama of meme stocks, urging you to pile into the next parabolic surge. Fueled by nothing but the desperate, contagious panic of the fear of missing out, the all-consuming FOMO that has come to define the Robinhood generation. This hyper-speculative zero-sum game, constantly played out on a phone screen, promises shortcuts to the FIRE movement, financial independence, retire early, but too often delivers only volatility and ruin. Yet, beneath this digital froth, beneath the crypto hype cycles and the breathless pronouncements of financial influencers, there exists a slower, steadier, fundamentally different path to wealth, one rooted in the tangible, in the brick and mortar, the real world. A path that offers not lottery tickets, but predictable, reliable income, paid for by the necessities of modern civilization. This is the world of real estate, specifically the world unlocked by Brad Thomas in his essential work, The Intelligent REIT Investor. Thomas is not an academic economist, but a battle-tested financial journalist, investor, and educator who spent decades immersed in the complex, rewarding discipline of real estate investment trusts, or REITs. His history is one of meticulous observation, disciplined analysis, and a relentless focus on income generation. He recognized early on that the traditional lure of real estate, stability, inflation hedging, and consistent cash flow, was often inaccessible to the average investor, requiring massive capital, specialized knowledge, and illiquid holdings. Thomas's work is dedicated to showing how the REIT structure democratizes this asset class, allowing any investor to participate in institutional-grade real estate, from data centers to distribution warehouses, with the liquidity of a publicly traded stock. The relevance of Thomas's blueprint in today's financial environment is monumental, and it serves as the perfect antidote to the mania of the moment. We live in an era defined by two seismic shifts: global inflation waves and the digital amplification of irrational trading behavior. When central banks print money and goods prices soar, traditional fixed-income investments like bonds crumble. Real estate, by its nature, is one of the few asset classes that naturally hedges against inflation, as rents and property values tend to rise with the cost of living. Thomas's book reveals how REITs, which are legally required to distribute at least 90% of their taxable income to shareholders, transform this inflation hedge into a consistent, rising income stream. This focus on predictable dividend income stands in stark opposition to the speculative thrill of chasing paper gains, which is often the sole motivation behind the Tesla hype or the volatility of Bitcoin bubbles. For FIRE movement, Thomas's work offers a sustainable, non-leveraged strategy to achieve true financial independence. While the Robinhood generation often seeks instant retirement through hyper-speculation, the realistic foundation of early retirement is a dependable stream of passive income that covers living expenses. REITs, when chosen wisely to the framework laid out in this book, provide precisely that robust income base, allowing an individual to transition from accumulating capital to living off their assets with confidence and minimize volatility. It introduces a vital old-school perspective into a new-age trading psychology that income is a measure of financial security, not a soaring and proven stock price. By connecting the timeless lessons of fundamental real estate ownership to the modern, accessible structure of the REIT, Thomas empowers the intelligent investor to build lasting wealth, steering clear of the fleeting, destructive temptations of the digital casino and focusing instead on the tangible, essential infrastructure of the modern world. This is a journey toward financial security built on leases and cash flow, not hype and speculation. The journey into intelligent real estate investing begins not by looking at hot zip codes or trendy developments, but by understanding the unique mechanism that delivers real estate cash flow directly to the individual. The Real Estate Investment Trust, or RIT. Brad Thomas starts here, meticulously detailing the structure that underpins this powerful asset class. A REIT is essentially a company that owns, operates, or finances income-producing real estate. Its structure was created by Congress in 1960 to allow ordinary investors to participate in large-scale, professionally managed real estate. This is the ultimate democratization of an asset that was once exclusive to the ultra-wealthy. The core blueprint of a REIT lies in its tax structure. The reason REITs are fundamentally income vehicles is their legal mandate. They must distribute at least 90% of their taxable income back to their shareholders. This critical feature eliminates the corporate income tax, meaning the income is taxed only at the shareholder level. This mandatory distribution ensures that the cash generated by the underlying properties, from monthly rent checks collected from industrial tenants or apartment residents, must flow consistently to the investor. Thomas emphasizes that this mandatory dividend is what separates REITs from standard growth stocks, which can hoard cash and indefinitely defer investor payouts. For the REIT investor, cash flow is not optional. It is structural. This predictable flow is the basis for a reliable income stream, which, unlike the capital gains chased by the Robin Hood generation, provides a necessary foundation for financial planning and retirement. To truly appreciate the value of this structure, one must contrast it with the illiquidity and complexity of direct property ownership. A private investor buying an apartment building must source debt, deal with tenants, manage maintenance, and eventually face the massive transaction costs and time delays of selling the asset. The REIT model solves all of this. It is professionally managed, highly diversified across potentially hundreds of properties, and is bought and sold instantly on a stock exchange via zero-commission trading. This liquidity is a massive, often underappreciated advantage, allowing an investor to adjust their exposure to real estate market without the friction that defines private property ownership. The shares represent a small, manageable piece of an institutional-grade portfolio. Thomas stresses that the intelligent investor must treat the REIT not as a stock, but as a publicly traded piece of land and buildings. The fundamental drivers of its value are therefore the quality of its underlying assets, the length and reliability of its leases, and the creditworthiness of its tenants. This requires a shift in focus away from the volatility and hype that drives meme stocks and toward the mundane, yet essential metrics of property economics. A REIT focus on high-quality distribution warehouses, for example, is driven by the growth of e-commerce, not by viral social media attention. Its income is secured by multi-year leases with blue-chip companies, offering stability that paper assets often cannot match. This inherent tie to tangible, income-producing assets makes the REIT a natural counterbalance to the abstract speculation of crypto hype cycles. Understanding this blueprint requires a commitment to a long-term, income-focused mentality. While REITs offer capital appreciation potential as property values rise, the primary reason for their inclusion in portfolio is the income, and the power of that income to consistently grow and compound. Thomas's analysis forces the reader to acknowledge that a steady, rising dividend stream is a far more reliable foundation for long-term wealth than chasing ephemeral gains provided by assets driven purely by collective narrative. It is a slow, methodical accumulation of wealth, paid for by the enduring economic need for physical space, from hospitals to data centers, a form of wealth generation immune to the whims of day trading psychology. The core challenge of the modern REIT investor is separating income quality from mere yield height. In an era where cheap leverage through technology has allowed many companies to load up on debt, a high dividend yield can sometimes signal distress rather than value. Thomas's principles require a diligent application of the principle of value, from LeBron's framework to the REIT space. When a REIT's yield spikes, the intelligent investor must ask, is this a sign of market panic, creating an opportunity? A high-quality asset is temporarily discounted, or is it a sign that the dividend is unsustainable due to excessive leverage or declining occupancy rates? Furthermore, the rise of social media financial panic cycles has added volatility to this traditionally stable asset class. A temporary fear about interest rates or a specific sector can cause a broad REIT sell-off. The disciplined investor must use this volatility as an advantage, treating it as a signal that the market is mispricing the assets. While REITs may not have a viral appeal of Tesla hype, their predictable cash flow provides a vital mechanism for weathering downturns, as the dividends continue to be paid while the market panics, allowing the investor to dollar-cost average into value during periods of external stress. The REIT, properly understood, is the income-oriented safe harbor against the emotional storms of the speculative market. If Chapter 1 provides a structural understanding of the REIT, Chapter 2 forces the investor to become a meticulous due diligence detective, Brad Thomas makes it clear that investing in an REIT is the equivalent of buying a piece of a business. An intelligent investor must analyze that business with the same skepticism and rigor applied to any other equity holding. The focus shifts from the abstract stock price to the tangible details: the quality of the management team, the financial health of the balance sheet, and the economic durability of the property portfolio. This deep dive is a necessary defense against the opaque complexity and poor execution that can hide behind the appealing structure of the REIT. The most critical, yet often overlooked, component is the quality of the management team. In the REIT world, management is everything, as they are the ones allocating capital, deciding which properties to buy, which to sell, and how much debt to use. Thomas emphasizes looking for management teams that are aligned with shareholder interests. This means checking if the executives hold a significant equity stake in the REIT, ensuring their wealth is directly tied to the long-term performance of stock, not just short-term compensation bonuses. Furthermore, the investor must study the management's capital allocation history. Do they consistently buy properties at reasonable valuations? Do they issue equity conservatively, or do they constantly dilute existing shareholders with poorly timed offerings? A history of conservative management, transparent communication, and a focus on long-term value creation over short-term deal-making is paramount. A lack of this due diligence is precisely how many Robinhood generation traders get burned, as they focus only on the ticker symbol and ignore the people running the show. Next, the detective must meticulously examine the balance sheet. While Chapter 4 will look at debt in detail, the initial due diligence requires a sober assessment of financial stability. A REIT, by its nature, uses leverage, but the intelligent investor looks for safety. Strong interest coverage ratios, EBITDA divided by interest expense, and low loan-to-value ratios, debt compared to property value. Thomas cautions against REITs that rely on constant refinancing of short-term debt, as this creates a profound vulnerability when credit markets tighten, a lesson brutally demonstrated during the 2008 crisis and highly relevant in today's environment of rising interest rates and global inflation waves. A fortress balance sheet provides the necessary resilience to withstand economic downturns and allows the company to capitalize on opportunities that arise when less disciplined, over-leveraged competitors are forced to sell. The final and most tangible part of the detective work involves scrutinizing the property portfolio and sector exposure. Thomas insists that the investor must understand what they own. Owning a regional mall REIT, for example, requires understanding the secular headwinds facing traditional retail, while owning an industrial REIT means understanding global supply chain logistics. The intelligent investor looks for portfolios positioned in high-growth, high barrier-to-entry markets, where supply is limited and demand is strong. A well-diversified portfolio reduces the risk associated with any single tenant or local economic downturn. The rapid growth of sectors like data centers and cell towers, driven by the digital revolution, offers strong tailwinds, but the detective must still assess the contract lengths and the credit quality of the tenants, ensuring the income stream is secured by creditworthy entities like major tech companies, not fleeting, highly speculative startups. This due diligence process provides the essential intellectual friction necessary to combat the impulsive nature of modern trading. It requires weeks of reading annual reports and investor presentations, a level of commitment that runs counter to the instant gratification-based culture of chasing meme stocks and fleeting gains. It is the core of the active approach, where the investor earns their returns not through speculation, but through superior informed judgment, a process that is miles apart from the passive, automated advice often given by robo-advisors. The digital age has introduced new complexities to due diligence, particularly regarding cybersecurity risk and obsolescence risk. For REIT sectors like data centers, cell towers, and even certain industrial facilities, the integrity of the technological infrastructure and the speed of hardware obsolescence are now critical factors. Thomas would advise the modern detective to scrutinize capital expenditure plans, ensuring that management is consistently investing to upgrade properties and maintain their technological edge. A REIT that skimps on CapEx to boost a short-term metric like adjusted funds from operations, AFFO, is violating the long-term principle of value. Furthermore, the influence of ESG, environmental, social, and governance factors has become essential due diligence. Investors must assess a REIT's energy efficiency, water usage, and community impact, not just for ethical reasons, but because poor ESG scores can directly impact financing costs, regulatory compliance, and tenant demand, ultimately posing a financial risk. The successful REIT of the future is one that minimizes its environmental footprint, a factor that requires careful examination of its operational reports, demonstrating that the due diligence detective's job is constantly evolving to encompass the new realities of the 21st century economy. In the world of REITs, traditional stock valuation metrics like earnings per share, EPS, are fundamentally misleading, and Brad Thomas dedicates this chapter to replacing those flawed tools with the specialized metrics necessary to master valuation. This is the intellectual bridge that separates a casual observer from the intelligent investor in the real estate space. The key is understanding that property depreciation, a non-cash accounting charge, significantly distorts EPS, making it an unreliable measure of a REIT's true operating performance and its capacity to pay dividends. The primary valuation tool championed by Thomas is funds from operations, FFO. FFO is calculated by taking net income, adding back depreciation and amortization, and subtracting any gains from the sale of property. By adding back depreciation, FFO provides a much clearer view of the actual cash flow generated by the properties. This metric is essential because it reflects the ongoing operational performance of the REIT and its capacity to support the dividend, the lifeblood of the investment. Thomas emphasizes that comparing a REIT stock price to its FFO per share yields a price to FFO, P/FFO ratio, the REIT equivalent of the price to earnings, PE ratio. A lower P/FFO ratio, assuming all other factors are equal, suggests better value. However, Thomas's rigor does not stop at FFO. He recognizes that even FFO is incomplete, leading the intelligent investor to the superior metric, adjusted funds from operations, AFFO. AFFO takes FFO and then makes crucial adjustments, primarily subtracting routine capital expenditures, CapEx, required to maintain the property portfolio, and sometimes smoothing out non-recurring items. This distinction is vital. While depreciation is a non-cash charge, a REIT must still spend money to replace roofs, update HVAC systems, and maintain common areas. These are real, necessary cash costs that reduce the amount available for distribution. AFFO, therefore, provides the most conservative and accurate measure of a REIT's true dividend-paying capacity and its intrinsic cash flow. An analysis of a REIT's AFFO payout ratio, dividends paid divided by AFFO, is the ultimate test of dividend safety. Thomas suggests that a consistently high payout ratio, say above 85 to 90%, should raise an immediate red flag, as it leaves little margin for error or for reinvestment into growth. The importance of these specialized metrics is amplified in the modern market, saturated with narratives and driven by speculation. While financial influencers might focus on daily price movements or catchy headlines, the valuation detective remains anchored to AFFO and P/AFFO. When a REIT stock price surges on positive sentiment, perhaps due to social media financial panic cycles or a temporary Tesla hype spillover, but the AFFO remains stagnant, the intelligent investor recognizes the immediate detachment from the principle of value and views the high price as a prime opportunity to sell or take profits. Conversely, a temporary downturn or panic selling can depress the stock price while the AFFO remains robust, signaling a strong opportunity for disciplined acquisition. Finally, Thomas discusses net asset value, NAV, a metric that attempts to determine the liquidation value of the REIT, what the properties would sell for today, minus all debt. Comparing the stock price to the NAV per share reveals if the REIT is trading at a premium or a discount to the underlying asset value. While NAV is subjective, relying on third-party appraisals, it provides a crucial anchor. The ultimate valuation strategy, therefore, is a tripartite analysis, using AFFO to measure the income stream, using P/AFFO to assess the relative value, and using NAV to gauge the asset value floor. Mastery of these three metrics prevents the investor from ever confusing a fleeting price movement with durable, underlying value. The increasing popularity of REITs as a substitute for traditional bonds in the FIRE movement necessitates extreme vigilance over the AFFO payout ratio. As more retirees rely on this income, The market's tolerance for dividend cuts, which is a major violation of the principle of discipline, has decreased. In a high global inflation waves environment, the intelligent investor must scrutinize not just the AFFO payout ratio, but the AFFO growth rate. A REIT with a low payout ratio and a consistently growing AFFO is a powerhouse because the growing cash flow increases the dividend safety margin while also providing capital for value-accretive growth, further protecting against the corrosive effect of inflation. For the Robinhood generation utilizing zero-commission trading platforms, the temptation to trade REITs based on simple P, E, or daily volatility is high. The modern investing reflection must emphasize that REITs require patience and deep valuation work. Attempt to apply quick, high-frequency trading strategies to a vehicle whose value is determined by quarterly rents and multi-year leases is a fundamental misunderstanding of the principle of time. REITs must be valued with the patient, long-term mindset of a private landlord, not the high-velocity, short-term focus of a momentum trader. In the real estate world, debt is a necessary tool, but excessive debt is a ruinous master. Brad Thomas's fourth chapter focuses entirely on the fortress balance sheet, emphasizing that the intelligent investor must prioritize safety and stability over the temptation of maximized debt-fueled returns. This chapter serves as a crucial check on the principle of value. Even a great property is a poor investment if the structure supporting it is too fragile. The foundation of a fortress balance sheet is conservative leverage. Thomas outlines several key ratios that act as the structural integrity tests for a REIT. Chief among these is the debt-to-EBITDA ratio, which measures a company's ability to service its debt using its operating cash flow. While the exact acceptable ratio varies by sector, Thomas generally favors REITs maintaining a debt-to-EBITDA ratio in the 5 to 7 range, or even lower, depending on the predictability of the cash flows. A ratio that creeps toward 9 or 10 indicates aggressive leverage, turning the investment into a high-risk gamble vulnerable to economic shocks or rising interest rates. This disciplined approach to leverage stands in stark contrast to the leverage addiction seen in the hyper-speculative corners of the market, where excessive borrowing is often celebrated until the inevitable crash. Equally important is the unencumbered asset ratio. Encumbered assets are properties pledged as collateral against specific debt, which limits the REIT's flexibility. Unencumbered assets are free of such restrictions and can be used to raise new, cheaper debt, or, critically, can be sold to raise liquidity during a market panic. A high percentage of unencumbered assets, say above 70%, signals a highly flexible and resilient management team that has maintained optionality. This optionality is a massive advantage during periods of stress, allowing the REIT to scoop up distressed assets from less disciplined competitors, turning a downer into a major opportunity. Thomas also stresses the management of debt maturity schedules. A fortress REIT must avoid having a large percentage of its debt coming due in any single year, which exposes a company to refinancing risk. By staggering debt maturities, the REIT smooths out its exposure to the credit cycle. When global inflation waves push interest rates higher, an REIT with carefully laddered maturities can absorb the shock gradually, whereas a competitor facing a massive debt wall may be forced to refinance at exorbitant rates or, worse, sell assets at fire sale prices, fundamentally destroying shareholder value. This foresight and planning are hallmarks of the intelligent investor approach, contrasting sharply with the short-term, instant gratification mindset. The ultimate test of a fortress balance sheet is liquidity. This includes access to ample and used credit facilities, conservative cash holdings, and the ability to generate cash internally through retained AFFO. In the face of a crisis, such as a pandemic or a systemic financial event, liquidity is the only thing that matters. A highly liquid REIT can meet its obligations, continue its capital improvement plans, and maintain its dividend, all while others are scrambling for survival. This conservative financial positioning provides the necessary discipline and time for the underlying property values to eventually recover from temporary shocks. The lesson is timeless. Debt amplifies both gains and losses, and the intelligent application of debt is always focused on amplifying the safety of the income stream, not just the capital return. The volatility introduced by AI-driven hedge funds and algorithmic trading means that market panics can be deeper and faster than ever before. This rapid-fire risk environment makes the fortress balance sheet indispensable. Thomas would note that in today's market, the debt-to-EBITDA ratio is more critical than ever. Furthermore, the modern investor must scrutinize the composition of the debt. A reliance on floating-rate debt exposes the REIT to immediate pain during rate hike cycles, making fixed-rate debt a significant safety feature. The connection to ETF dominance is also relevant, as vast pools of passive capital flow into REIT ETFs. These funds often buy indiscriminately based on market capitalization, regardless of the underlying balance sheet quality. This passive flow can artificially inflate the prices of poorly managed, highly leveraged REITs, masking their fragility. The intelligent, active investor must see through this, recognizing that a cheap, well-managed REIT with a fortress balance sheet, even if it has a smaller market cap, provides a significantly better risk-adjusted return than a highly leveraged giant being blindly bought by passive funds. The fortress balance sheet is the non-negotiable insurance policy against both economic shocks and the inherent volatility introduced by modern, passive market flows. The final piece of the due diligence puzzle, and the focus of Brad Thomas's fifth law, is a strategic selection of sector and property type based on an understanding of economic cycles and secular trends. Real estate is not a monolithic asset class. The performance of an office tower, a self-storage unit, and a data center are driven by entirely different economic forces. The intelligent investor tailors their sector exposure to match their economic outlook and personal risk profile. Thomas categorizes the REIT universe into distinct economic drivers. Industrial REITs, warehouses, logistics, are driven by e-commerce penetration and global supply chain efficiency. Residential REITs, apartments, single-family rentals, are driven by employment, wage growth, and housing affordability. Healthcare REITs, hospitals, senior housing, are driven by demographics, specifically the aging global population. And data center/cell tower REITs are pure technology plays, driven by data consumption, 5G deployment, and cloud computing. The intelligent investor must possess a deep, almost clinical understanding of these different economic engines. The challenge of sector selection is navigating the powerful, yet often contradictory, secular trends. For instance, the Tesla hype and the technological revolution have created massive demand for data centers and industrial space, making these sectors historically strong. However, Thomas cautions against simply chasing the hottest sector. By the time a sector becomes universally hot, the principle of value may already be violated, with prices reflecting overly optimistic growth assumptions. The truly intelligent investor identifies emerging secular trends before they become mainstream, such as the early shift to cold storage logistics or specialized life science labs, and is willing to acquire high-quality assets in those sectors at reasonable valuations. Conversely, some sectors, like traditional retail, malls, and office space, face strong secular headwinds from e-commerce and remote work, respectively. This doesn't mean they are uninvestable. It means the due diligence detective must apply extreme rigor. A retail REIT owning a portfolio of failing low-grade malls is a toxic asset, but retail REIT owning a portfolio of highly coveted, urban, experiential retail centers is a fortress. The key is to distinguish between the secular trend destroying the poor assets in a sector and the secular trend rewarding the superior, resilient assets in that same sector. Thomas also stresses the importance of adjusting sector exposure based on the economic cycle. In an early cycle recovery marked by cheap leverage through technology, speculative, development-heavy REITs might offer the highest growth potential. In a late cycle environment marked by global inflation waves and slowing growth, defensive sectors like healthcare, non-discretionary spending, and necessity-based retail grocery stores with long, inflation-linked leases become significantly more valuable. This active management of sector rotation, guided by macroeconomic analysis, is a final layer of sophistication for the active REIT investor. It is a nuanced strategy that stands completely apart from the buy-watch trending mentality of the Robinhood generation. The rise of AI-driven hedge funds and algorithmic trading now heavily influences sector valuation. Algorithms tend to aggregate information and rush into or out of entire sectors based on key data releases or interest rate forecasts, creating temporary, sector-wide mispricings. For example, a minor negative report on e-commerce logistics might cause an entire industrial REIT sector ETF to drop sharply. The intelligent investor uses this algorithmic overreaction as a key opportunity, knowing that the underlying leases and cash flows of their well-vetted REITs are secure. They treat the sector-wide drop as a temporary gift of market liquidity, allowing them to acquire high-quality assets at a discount. Furthermore, the integration of fractional shares culture and robo-advisors means investors can now easily build highly diversified REIT portfolios. Thomas would endorse the broad diversification across 3 or 4 non-correlated sectors, e.g. data centers, healthcare, and industrial, as a core tenet of FIRE-based asset allocation, minimizing risk. However, he would caution against over-diversification into too many sectors, which leads to a violation of the principle of simplicity and makes effective due diligence impossible. Strategic, focused diversification across carefully selected, high-quality sectors is the ultimate goal. If Brad Thomas were to observe the financial landscape of the 2020s, dominated by digital volatility and unprecedented technological change, he would not be surprised by the chaos, but he would be intensely focused on how his timeless principles of real estate investing provide a crucial grounding force. He would assert that while the vehicle of speculation has changed from railroads to crypto casinos, human greed, fear, and the enduring need for reliable income have not. Thomas would analyze the impact of AI-driven hedge funds and quant strategies on REITs. He would conclude that while these systems can quickly arbitrage small price discrepancies, they struggle with the core, non-quantifiable factors that drive REIT value: the quality of the local real estate market, the political stability of a region, the durability of a specific property's location, and the subjective quality of the management team. This is where the intelligent investor retains a decisive edge. A quant model can easily calculate AP/AFFO ratio, but cannot easily assess the integrity of the board or the future secular trend of a new metro area. Thomas would advise, let the algorithms handle the small-scale, high-frequency price fluctuations and focus the human mind on the large-scale, slow-moving, fundamental value judgments. The pervasive influence of financial TikTok and YouTube gurus promoting meme stock manipulation would be viewed as a dangerous distraction from the core business of wealth building. Thomas would compare the fleeting nature of digital hype to the durability of a 30-year industrial lease with an Amazon or a major healthcare provider. He would argue that the pursuit of day trading psychology in the 2020s, try to time entries and exits based on social media sentiment, is a violation of the principle of time and leads to certain failure in the REIT space, which requires patience for its cyclical nature to reward the investor. He would emphasize that digital markets amplify greed and fear, but the value of a REIT is anchored to the tangible reality of rent checks, a truth that no amount of social media frenzy can erase. The phenomenon of global inflation waves and the resulting rise in interest rates would be central to Thomas's modern analysis. He would stress that the REIT is not just an income asset. It is a powerful inflation hedge. As construction costs rise, the replacement cost of existing properties increases, boosting their long-term value. Crucially, in a period of high inflation, rents can be reset higher, directly increasing the funds from operations FFO and the dividend payout. He would compare the inflation hedging power of a high-quality REIT with inflation-linked leases to the vulnerability of holding cash or fixed-rate bonds, proving that tangible assets are the ultimate protector of purchasing power. This timeless concept is highly relevant to the FIRE movement, where preserving the real value of capital is paramount. Our exploration of the Intelligent REIT Investor by Brad Thomas has revealed a path to wealth that is both fundamentally sound and profoundly relevant to the volatile financial world of today. The 6 core lessons he imparts are not just trading tips. They are timeless principles of conservative capital allocation, risk management, and the pursuit of durable, real-world value. The ultimate lesson is that true wealth is measured not by how much your paper assets gain on a given day, but by the income your assets generate, a recurring stream that provides genuine financial freedom. Here are 10 timeless principles distilled from Brad Thomas's framework, showing how any normal person today can apply these lessons to their financial life and build a resilient income machine. Income is the ultimate metric. Prioritize assets that generate predictable, high-quality, growing income. The REIT's mandatory payout structure forces this discipline. Relying on dividends and cash flow provides a stability that ephemeral capital gains cannot match, which is a true definition of financial independence for the FIRE movement. Asset quality is non-negotiable. Invest only in properties that are essential, durable, and located in high barrier-to-entry markets. Avoid low-grade properties in declining sectors. The value of a REIT is only as strong as its weakest property. Master the specialized language. Reject flawed metrics like EPS and anchor your valuation to adjusted funds from operations AFFO. AFFO is the truest measure of a REIT's dividend-paying capacity and its operational health. Balance sheet is the insurance policy. Demand a fortress balance sheet characterized by conservative leverage, low debt to EBITDA, high interest coverage, and carefully staggered debt maturities. Safety, in the realm of real estate, always precedes speculation. Management alignment is crucial. Treat the management team as a business partner. Invest only when management's interests are clearly aligned with shareholders, signaled by significant equity ownership, conservative capital allocation, and transparent communication. Patience pays the rent. Recognize that real estate is a slow-moving, cyclical asset. The principle of time dictates that the best returns are generated over decades, not days. Ignore the high-frequency noise of zero-commission trading and trust the long-term compounding power of cash flow reinvestment. Hedge against inflation. View real estate as a necessary hedge against global inflation waves. As the cost of goods rises, so should the value of land and the rents collected on buildings, protecting the real purchasing power of your capital. Strategic sector focus. Understand the specific economic drivers of each REIT sector, from demographics for healthcare to data consumption for tech. Focus on 3 to 4 non-correlated high-quality sectors rather than over-diversifying into complex areas where due diligence is impossible. Exploit behavioral mispricing. Use moments of market panic, often triggered by algorithmic trading or social media financial panic cycles, as opportunities to acquire high-quality REITs at discounted prices. The market emotional overreaction is the intelligent investor's greatest gift: simplicity and focus. Keep your REIT portfolio focused and manageable. Avoid complexity, excessive leverage, and low conviction positions. The simplest strategy, buying high-quality assets at a good price and holding them for the income, is the most robust and profitable over the long term. These principles emphasize long-term thinking, calmness, patience, and unyielding emotional discipline. They are a guide to building a resilient, passive income stream that provides true financial security, separating the wealth builder from the speculator. By applying the rigor of Brad Thomas, the investor steps off the volatile roller coaster hype and anchors their future in the reliable cash flow of the real world. The journey through Brad Thomas's Intelligent REIT Investor has shown us that true, enduring financial freedom is not found in the chase for viral gains, but in the methodical accumulation of income-producing, tangible assets. We have revealed the inner workings of the REIT, the metrics that matter, and the due diligence required to build a fortress of passive income. You now possess the foundational knowledge to transform your approach to real estate, replacing speculative hope with a rigorous, conservative, and profitable strategy. You understand that the chaos of the crypto hype cycles and the meme stock frenzy are merely distractions from the quiet, powerful work of wealth accumulation through predictable cash flow. If you found value in this deep, cinematic breakdown of the Intelligent REIT Investor, make sure to subscribe to Capitura, because next we're covering another classic that can completely change how you think about money and markets. Our next deep dive will reveal the psychological traps that undermine every investor, giving you the mental tools necessary to implement Brad Thomas's framework with unshakable discipline. Hit that subscribe button and ring the notification bell so you don't miss a thing. Thank you for listening, and may your dividends always be rising. The screen glows with the promise of impossible speed. An alert flashes. A cryptic digital token has just surged 50% in a single hour. The feeling is immediate, visceral, and overwhelming. It is a fear of missing out, a psychological contagion weaponized by social media and powered by cheap leverage through technology. In the modern financial arena, success is often equated with the velocity of speculation. We are constantly barraged by the dazzling noise of the Robinhood generation, who chase meme stocks to astronomical, unjustified valuations and treat the volatile world of crypto hype cycles as a high-stakes lottery. This environment encourages a mindset of get rich quick, where the tangible, slow-moving principles of wealth creation are dismissed as relics of the past. The goal of the FIRE movement, financial independence, retire early, has been tragically mutated from disciplined saving and investing into a quest for a single, life-altering, short-term trade. Yet, this high-velocity digital mania exists alongside an enduring, fundamental reality. The world still needs places to live, to work, to store goods, and to transfer data. Every great technological leap, every surge in Tesla hype, every transaction in a Bitcoin bubble, every scroll on social media requires a physical box, a piece of land, a tangible structure. This is the bedrock of the global economy, and it is governed by an asset class immune to digital deletion, real estate. The challenge for modern investors is how to participate in this stable, income-producing reality without the massive capital, the illiquidity, and the management headaches of being a private landlord. This is a precise problem solved by Brad Thomas in his essential work, The Intelligent REIT Investor. Thomas, a veteran observer of the financial markets and a respected voice in real estate finance, provides an essential bridge. He recognized that the publicly traded real estate investment trust, REIT, is the ultimate mechanism for democratizing institutional-grade real estate exposure. His history is marked by a refusal to chase fleeting trends, focusing instead on a meticulous analysis of income durability, balance sheet strength, and management integrity. The book is not merely an investment guide. It is a declaration of independence from the speculative frenzy, a manifesto for building sustainable, long-term wealth powered by the fundamental economic necessity of physical space. The book's relevance is amplified tenfold in the current era. As global inflation waves wash over the economy, the search for assets that preserve purchasing power and deliver reliable, rising income becomes paramount. Thomas's framework positions REITs as the superior answer. Unlike fixed-income instruments that are decimated by inflation, REITs own assets whose rents and values appreciate with the rising cost of living. This inflation hedging quality, combined with a legal mandate to distribute 90% of taxable income, creates a potent counterforce to the volatility and capital-destroying nature of speculative assets. Where financial influencers might promise outsized, fleeting gains, Thomas offers a quiet certainty of compounding income. Furthermore, the Intelligent REIT Investor provides a necessary, stabilizing corrective to the New Age trading psychology. This psychology is characterized by immediacy, leverage, and the substitution of due diligence with groupthink, often encouraged by zero-commission trading which eliminates the financial friction that once moderated impulse. Thomas's methodology, which demands deep analysis of specialized metrics like AFFO and relentless scrutiny of debt schedules, forces the investor to engage in disciplined, long-term thinking. It rejects the high-risk, zero-sum game of option gambling and anchors the investor to the tangible economic engine of the underlying properties. By framing REIT investing as a patient, methodical ownership of infrastructure, from cell towers and data centers to industrial distribution hubs, Thomas gives the investor a powerful, rational mechanism to achieve the real goals of the FIRE movement: predictable cash flow and financial resilience, a foundation built on brick and mortar, not abstract code or ephemeral social hype. This book is the ultimate cinematic journey into stability, a calming voice of reason in the loudest financial market in history. The deep blueprint for safe income begins with profound legal and economic genesis of the REIT. Brad Thomas meticulously explains that the real estate investment trust structure, established by U.S. law, is less a type of stock and more a tax pass-through vehicle. This mechanism is key to understanding its income power. By mandating the distribution of at least 90% of taxable income, Congress ensured that investors could access large-scale real estate cash flows without the double taxation penalty faced by typical corporations. This single rule creates an investment vehicle structurally designed for income, not for hoarding cash or speculative reinvestment, a discipline that serves as a powerful contrast to many highly valued growth companies that perpetually promise future earnings while delivering none today. Thomas emphasizes that the income derived from REITs is sourced from the fundamental necessity of physical space. Unlike profits dependent on fleeting consumer trends, technological shifts, or competitive disruption, REIT cash flows are secured by leases, legally binding contracts that promise regular rent payments over multi-year periods. The intelligent investor must train themselves to see past the stock ticker and focus on quality of these leases. The duration, the embedded rent escalators, crucial during global inflation waves, and the credit strength of the tenant. A REIT with long leases to creditworthy tenants, like major logistics firms or government agencies, possesses a degree of cash flow predictability that few common stocks can rival, providing a necessary balance against the uncertainty fueled by social media financial panic cycles. The illiquidity of direct property ownership is the great barrier to entry that the REIT structure annihilates. Thomas highlights the true genius of the REIT. It takes an illiquid, high-friction asset, a skyscraper or a logistics park, and transforms it into a liquid, tradable security. The ability to buy or sell a piece of diversified portfolio instantly through a platform offering zero-commission trading is an immense, yet often underappreciated, advantage. It eliminates the seven-figure capital requirement, the lengthy closing times, and the massive transaction costs of the private market. This liquidity is especially critical in times of crisis, allowing the disciplined investor to adjust their risk exposure or capitalize on opportunity, without being trapped by an inability to sell, a vulnerability that haunts direct real estate owners. A significant portion of Thomas's discussion here is dedicated to the relationship between the REIT structure and debt. A REIT is inherently a leveraged vehicle. Real estate relies on mortgages. The blueprint for safe income requires understanding good debt versus bad debt. Good debt is conservatively sized, as detailed in Chapter 4, long-term, fixed-rate, and used to acquire high-quality, income-producing assets at favorable valuations. Bad debt is short-term, floating-rate, excessively large, and used to fund speculative development or maintain unsustainable dividends. The blueprint for safe income is therefore inseparable from the blueprint for safe leverage, emphasizing that the mandatory distribution of cash flow must not compromise the long-term financial stability of the balance sheet. This disciplined approach to income generation serves as a deliberate counterpoint to the recklessness of leverage addiction seen in the broader speculative market. The ultimate power of the REIT blueprint lies in the compounding effect of reinvested dividends. While the raw yield is attractive for the FIRE movement, the real wealth is created when those dividends are systematically reinvested to buy more shares, which, in turn, generate more dividends. This creates a geometric growth engine, a steady, inexorable accumulation that stands in opposition to the parabolic volatility of speculative assets. Thomas insists that the investor must possess the patience dictated by the principle of time to allow this compounding machine to operate over decades, demonstrating that the safest path to wealth is often the slowest and most predictable. The core challenge for the modern REIT investor is the need to distinguish between taxable dividend income and return of capital ROC. Thomas would dedicate time to educating the Robinhood generation that a REIT's distribution often includes ROC, which is tax-deferred and reduces the cost basis of shares. While this offers immediate tax benefits, the intelligent investor must understand that the true measure of a distribution's quality remains AFFO. A high yield funded primarily by ROC or excessive leverage is a sign of financial manipulation, not operational health. The principle of value demands that the investor focuses on the source and durability of the cash flow, AFFO, rather than the size and tax treatment of the immediate payout. The rise of robo-advisors and generic ETF dominance can obscure these vital technical details, requiring the active investor to look deeper, ensuring that the income they are relying on for their FIRE-based asset allocation is structurally sound and sustainable across economic cycles. Brad Thomas's call to become a due diligence detective is a command to reject passive consumption of financial news and embrace active, skeptical analysis. This chapter is the intellectual crucible where the investor's commitment to safety is tested, moving beyond mere property appeal to the complex, nuanced analysis of corporate governance, tenant quality, and geographical exposure. The detective must look for the cracks in the foundation that market hype often conceals. The deepest layer of detective work focuses on management integrity and alignment. Thomas emphasizes that poor management can ruin the best real estate portfolio. The detective must scrutinize the management team's track record over a full economic cycle. How did they navigate the last recession? Did they cut the dividend unnecessarily, or did they seize the opportunity to acquire assets cheaply? Crucially, Thomas highlights the danger of the external manager model, where an outside firm manages the REIT for a fee, creating a potential conflict of interest where the manager is incentivized to maximize assets under management, and thus their fee, rather than maximize shareholder returns. The preference, Thomas argues, is almost always for internally managed REITs, where the executives are direct employees and their compensation is tied directly to the long-term performance metrics like AFFO growth and share price appreciation. Next, the detective must meticulously analyze tenant credit risk. The quality of a REIT's income is only as good as the creditworthiness of the companies paying the rent. Thomas would advise analyzing the tenant roster not just by name, but by credit rating and sector concentration. Owning a healthcare REIT whose income is concentrated in one or two financially fragile regional hospital systems is a massive violation of the principle of risk. The intelligent investor seeks diversification across numerous high-credit tenants with long lease terms, ensuring that the failure of any single tenant does not critically threaten the dividend. This focus analysis contrasts sharply with the meme stock manipulation approach, where the underlying business viability is often ignored entirely in favor of short-term price momentum. The detective must also engage in geographical and market analysis. A warehouse in a rapidly expanding logistics hub near a major port holds demonstrably higher value than a similar warehouse in a stagnant or declining regional market. Thomas stresses the importance of barrier-to-entry analysis. Does the REIT own properties in cities where local zoning, environmental hurdles, or land scarcity make new development difficult or prohibitively expensive? If so, the existing properties possess a valuable moat that protects the REIT's rents from competition. This qualitative analysis of the underlying real estate is the critical value judgment that AI-driven hedge funds and generic robo-advisors struggle to replicate, providing the individual investor with a powerful competitive edge. Finally, the modern detective must assess property-level obsolescence risk. In an era of rapid technological change, certain physical assets age faster than ever. For example, a traditional low-ceilinged retail mall may face terminal obsolescence, while a traditional office building may become redundant due to the remote work revolution. The detective must study the REIT's capital expenditure (CapEx) history. Are they spending enough to modernize their properties and keep them relevant? A management team that aggressively cuts maintenance CapEx to artificially boost AFFO is mortgaging the future to flatter the present, a clear warning sign of a violation of the principle of value. This deep scrutiny confirms that successful REIT investing is an active, sustained process, not a passive one-time purchase. The rise of ESG, environmental, social, and governance mandates has added a critical layer of due diligence. Thomas would insist that the modern detective must view strong ESG scores not as altruism, but as a form of risk mitigation and value creation. A REIT that invests in green building technology, energy efficiency, and community planning is mitigating future regulatory risks, reducing utility costs, and attracting higher credit, increasingly ESG-conscious tenants. Conversely, a REIT with poor environmental compliance faces potential fines and structural obsolescence in a world moving toward carbon neutrality. This is a clear case where ethics aligns with economics, proving that sustainable practices are integral to the fortress balance sheet and long-term AFFO growth, offering predictable return that hyper-speculative assets like NFT madness can never provide. The mastery of REIT valuation is a core discipline that transforms a property speculator into an intelligent investor. Brad Thomas insists on the abandonment of conventional equity-based metrics, which are fundamentally misleading due to the nature of real estate accounting. This chapter serves as a rigorous mathematical training ground, replacing abstract hope with quantifiable certainty. The foundation, as established, is funds from operations FFO. Thomas delves deeper, explaining conceptual integrity of FFO. Since real estate assets appreciate in the long run, the mandatory accounting depreciation is merely a paper expense, a non-cash charge. FFO reverses this to show the true, recurring cash flow generated from rental operations. The price to FFO, P/FFO, multiple thus becomes a primary comparative tool, allowing an investor to judge if they are paying a reasonable price for the stream of earnings. The intelligent investor maintains a constant database of sector-specific P/FFO averages, understanding that a specialty REIT like a cell tower will command a higher multiple than a cyclical one like a hotel due to its superior lease stability and growth prospects. However, the real intellectual leap, Thomas stresses, lies in adjusted funds from operations, AFFO. This is the gold standard. He meticulously breaks down the adjustments required to get from FFO to AFFO, which primarily involves subtracting recurring, non-deferrable capital expenditures. This is a critical distinction. A REIT can technically report strong FFO while simultaneously allowing its properties to decay by neglecting necessary maintenance CapEx. This management choice artificially inflates FFO, but destroys long-term value. AFFO corrects for this, providing the purest measure of cash flow truly available for distribution to shareholders. Thomas provides the ultimate safety test, the AFFO payout ratio. An optimal ratio is typically between 70% and 80%, leaving a necessary buffer for retained earnings to fund future growth, cover unexpected operational costs, and, critically, provide a safety net against temporary tenant defaults. Thomas dedicates significant space to the concept of net asset value, NAV, and its utility as a sanity check. While FFO and AFFO measure the cash flow, NAV estimates the liquidation value of the assets, what the property portfolio would be worth if sold today, minus the debt. Thomas cautions that NAV is subjective, relying on appraisal estimates, but serves as a powerful indicator of market sentiment. When a REIT trades at a deep discount to its NAV, say 20% below, it signals that the market is either overly pessimistic about the management or the sector, presenting a high-conviction opportunity for the patient investor. Conversely, when a REIT trades a large premium, say 30% above NAV, the principle of value is likely being violated, and the price reflects irrational exuberance or Tesla hype spillover, signaling a time to take profits. The difficulty in mastering these metrics is compounded by the modern market's tendency to focus on low-information data. Financial influencers in the Robinhood generation often gravitate towards simple PE or daily price changes, creating the very mispricings that the diligent AFFO analyst can exploit. Thomas's lesson is that superior returns in REIT investing are a function of superior information and superior patience, derived from specialized knowledge that is unavailable to the casual speculator. The quantitative discipline of AFFO ensures that the investor's emotional response to price volatility remains anchored to the concrete, verifiable reality of the rental income stream. The rise of global inflation waves has introduced a new valuation factor, the quality of rent escalators. Thomas would advise the modern valuation expert to scrutinize leases for two types of growth: fixed escalators, e.g. 2% annual increase, and CPI-linked escalators, linked to the Consumer Price Index. In a high inflation environment, fixed escalators rapidly cause the property's real rent value to decline, while CPI-linked escalators ensure the AFFO growth keeps pace with inflation, protecting the investor's purchasing power. The valuation model must therefore incorporate not just the current AFFO, but the guaranteed growth rate of that AFFO, recognizing that a REIT with strong CPI-linked leases should command a higher P/AFFO multiple than one with static, fixed-rate leases. This nuanced, deeper analysis is the cutting edge of applying the principle of value in the 2020s. The fortress balance sheet is the financial armor that protects the REIT investor from the vicissitudes of the market and the inevitable cyclical downturns of the real estate sector. Brad Thomas elevates this concept beyond simple debt management, presenting it as a crucial element of the principle of risk and a testament to managerial discipline. A poorly leveraged REIT can transform a temporary market hiccup into a forced liquidation, wiping out equity value even if the properties themselves retain intrinsic worth. Thomas focuses heavily on the structural differences between secured debt and unsecured debt. Secured debt is tied to specific properties, giving the lender the right to seize the property upon default, a mortgage. Unsecured debt is corporate-level borrowing, often in the form of bonds, backed by the REIT's general creditworthiness and unencumbered assets. Thomas strongly favors REITs that utilize a high proportion of unsecured, corporate debt backed by a large pool of unencumbered assets. This provides the REIT with maximum flexibility. During a downturn, it can sell unencumbered assets or pledge them for new financing without facing foreclosure risk on individual properties. This is the hallmark of sophisticated, conservative financial engineering that prioritizes optionality and survival. The deep dive into leverage ratios is essential beyond the debt-to-EBITDA ratio. Thomas introduces the Fixed Charge Coverage Ratio, FCCR. This metric measures the REIT's ability to cover all fixed charges, interest, scheduled principal payments, and preferred dividends with its operating cash flow. An FCCR consistently above 2.0 is considered safe. Anything below 1.5 signals potential distress. The FCCR provides a more complete picture of solvency than just debt to EBITDA, especially for REITs with complex debt structures. The intelligent investor must track this metric like a vital sign, recognizing that any sustained drop is a direct warning sign that the management's appetite for cheap leverage through technology has surpassed prudent risk limits. Thomas meticulously analyzes the debt maturity tower. This visual representation of when the REIT's debt obligations are due reveals the concentration of refinancing risk. A fortress balance sheet looks like a staircase, with debt obligations evenly distributed over time. A fragile balance sheet looks like a cliff, with a massive percentage of debt maturing in a single year. The latter exposes the REIT to the mercy of the credit markets during that crucial year. When global inflation waves cause sudden spikes in interest rates, the cliff-facing REIT is forced to accept punitive refinancing terms or resort to fire sale dispositions, destroying shareholder value. The disciplined management team mitigates this by laddering maturities and pre-funding future debt, sacrificing short-term interest savings for long-term resilience. Finally, Thomas stresses the importance of shareholder-friendly capital structure. A fortress balance sheet avoids overly complex instruments, particularly preferred equity with high, fixed dividend obligations that strain the cash flow during recessions. Furthermore, the management must demonstrate discipline by using common stock issuance sparingly and strategically, only when a stock is trading at a significant premium to NAV, ensuring that new capital is raised to fund value-accretive acquisitions without unnecessarily diluting existing shareholders. The ultimate function of the fortress balance sheet is to ensure the dividend safety that the FIRE movement relies upon, providing an unshakable foundation built on liquidity and low structural risk. The contemporary environment of rapid market stress, often triggered by AI-driven hedge funds selling off entire baskets of assets instantly, demands an unparalleled level of liquidity. Thomas would note that the definition of a fortress must now include the capacity to withstand a flash crash. The principle of risk requires not just low debt to EBITDA, but immediate, guaranteed access to large, untapped credit facilities. Furthermore, the modern investor must scrutinize the covenants on the debt, the legal promises the REIT makes to its lenders. Complex debt covenants can trigger an immediate default or liquidity freeze if a minor financial metric is violated. The fortress balance sheet is one whose covenants are broad, simple, and far from the current operating performance, offering maximum management flexibility when the day trading psychology in the 2020s triggers an external panic. The strategic selection of sector and economic cycles is the highest level operational discipline for the intelligent investor, requiring a blend of forward-looking macroeconomic analysis and granular property knowledge. Brad Thomas guides the reader away from generalized market sentiment and towards a specialized understanding of which property types thrive under specific conditions. This chapter is the ultimate expression of the principle of opportunity, demanding that the investor position their capital where secular trends and cyclical timing are most favorable. Thomas provides a detailed taxonomy of property sectors, emphasizing the unique value drivers of each. Industrial REITs are now technology infrastructure, driven by high-speed logistics, e-commerce returns, and supply chain reshoring, demanding high clearance ceilings and strategic proximity to major transportation hubs. Residential REITs are highly cyclical but essential, driven by local employment rates and demographic shifts. The true value here is found in Sunbelt markets experiencing strong population migration, contrasting sharply with stagnant legacy markets. Data center and cell tower REITs are hyper-growth tech plays, offering unparalleled long-term contracts and low-maintenance capital expenditure, but commanding premium valuations due to their stable, non-cyclical cash flows. The intelligent investor accepts a high P/AFFO multiple on these assets because the quality of the recurring cash flow justifies the price. A central theme is the contrarian sector opportunity. Thomas would analyze the office and retail sectors, often battered by the remote work revolution and e-commerce, as potential areas for deeply discounted value. He would caution against buying a struggling regional mall, but advocate for acquiring a trophy, mixed-use urban retail asset at a fraction of its replacement cost. The opportunity lies in distinguishing the structurally obsolete property from the temporarily discounted, resilient one. This requires patience and a firm commitment to principle of time, buying when the sector narrative is overwhelmingly negative, a strategy that is the polar opposite of the FOMO culture driven by financial influencers. Thomas also details the active management of economic cycle rotation. In the early recovery phase, cyclical sectors like apartments and hotels, which can raise rents quickly, offer maximum AFFO growth. In the late cycle, when capital is expensive and growth slows, the intelligent investor rotates toward defensive sectors like healthcare, non-discretionary, and triple net lease properties, long leases, no operational responsibility, which provide the maximum income stability necessary to withstand an inevitable recession. This cyclical awareness ensures that the portfolio is constantly positioned to maximize either growth or defense, depending on the macroeconomic climate, rather than remaining static and vulnerable. The ultimate sophistication in sector selection is understanding global economic impact. Thomas notes that global inflation waves have permanently altered sector valuation. Sectors with short leases, like self-storage or apartments, benefit from inflation because they can reset rents quickly. Sectors with long, fixed leases are vulnerable unless those leases contain strong, explicit inflation escalators. The strategic investor must therefore favor sectors that demonstrate a natural pricing power during inflationary periods, reinforcing the REIT's role as a vital inflation hedge for the FIRE-based asset allocation. The rise of AI-driven hedge funds and algorithmic trading creates unique, sector-specific volatility. When a major firm issues a negative report on commercial mortgages, algorithms can trigger a simultaneous sell-off across all financial and prop-related sectors, leading to indiscriminate selling of high-quality REITs that are fundamentally sound. Thomas would see this as a perfect modern opportunity, a systemic risk event that causes a temporary, sector-wide mispricing. The intelligent investor, with their fortress balance sheet and dry powder, buys into this technologically amplified panic, capitalizing on the machine's lack of nuanced, property-level due diligence. The key is to be psychologically prepared to be a lonely buyer during these short, intense panic events, trusting the principle of value over the collective fear broadcast by the market. The confluence of technological disruption, behavioral frenzy, and macro uncertainty demands a final, extensive application of Brad Thomas's timeless real estate laws. The digital revolution has changed how we trade, but not why real estate generates wealth. Thomas would analyze the impact of AI-driven hedge funds and quant strategies on the informational asymmetry that once favored the large institution. While algorithms eliminate simple arbitrage, they amplify the importance of behavioral risk. They struggle to price properties based on qualitative factors like tenant credit fragility or management integrity. The active human REIT investor's edge is now the long-term qualitative judgment, the ability to look past the algorithmic noise and identify value in assets that require complex, forward-looking analysis of social, political, and demographic trends. The era of financial TikTok and YouTube gurus and meme stock manipulation has turned many retail investors into volatility tourists. Thomas would emphasize that this is a zero-sum game that distracts from the non-zero-sum game of real estate investing. He would contrast the hyper-speculation in crypto casinos and NFT madness, assets lacking inherent cash flow and intrinsic value, with the tangible, predictable income of a REIT. The principle of value requires that an asset's worth be tied to future cash flow, not speculative narrative. A REIT pays you to wait. A speculative asset forces you to guess. This distinction is the core lesson for the Robinhood generation seeking stability for their FIRE movement goals. The structural impact of index funds dominating global wealth is a complex modern challenge. While REIT ETFs provide convenient diversification, the passive flow often leads to mispricing. These index funds are forced to buy and hold REITs based purely on market capitalization, regardless of the underlying financial health. Thomas would urge the intelligent investor to actively seek out high-quality, mid-cap REITs that are overlooked by the passive mandate, often finding significant mispricings and superior AFFO growth potential. The active investor uses the inefficiency created by the passive giant as their opportunity. Global inflation waves are the most direct modern application of Thomas's expertise. He would strongly advocate for real estate as the superior asset class, comparing inflation hedging qualities to the disastrous effects on fixed income investments. Furthermore, he would caution against the temptation of cheap leverage through technology when interest rates are rising. Borrowing heavily during an inflationary cycle can lead to punitive refinancing costs, destroying the fortress balance sheet. The disciplined strategy is to use leverage conservatively, ensuring that the rent escalators on the assets outpace the cost of the debt. Thomas would see robo-advisors and fractional shares culture as double-edged swords. They democratize access, fulfilling the original promise of the REIT structure. However, they also encourage low conviction, fragmented portfolios that violate the principle of simplicity. The ability to buy $10 worth of 40 different REITs leads to a lack of focus and diligence. The true intelligent investor uses these tools to consolidate capital into a few high-conviction, deeply analyzed names, maximizing the impact of their superior due diligence. The ultimate modern comparison is simple. Dollar cost averaging into high-quality, income-producing REITs is a disciplined, simple, time-aligned strategy, attempting day trading psychology on volatile assets, driven by fear and greed, is a mathematically losing strategy against the complexity and speed of the modern market. The journey through the Intelligent REIT Investor by Brad Thomas has been an exercise in rejecting the frenetic noise of the contemporary market and anchoring our financial future to the quiet certainty of real estate cash flow. It is a path that demands discipline, specialized knowledge, and an unwavering commitment to the tangible over the speculative. The 6 laws of REIT investing, from the structural safety of the blueprint to the strategic timing of sector selection, provide a coherent, powerful counter-narrative to the prevailing New Age trading psychology. Thomas teaches that in a world obsessed with speed, patience is the ultimate form of power. These principles provide the essential framework for calmness, patience, and emotional discipline. By anchoring your portfolio in the tangible, cash-flowing reality of real estate, you build a fortress against the volatility of the digital age, achieving a sustainable financial independence that is powered by necessity, not by fleeting hope. The journey through Brad Thomas's The Intelligent REIT Investor has stripped away the illusion of instant wealth, replacing it with the enduring reality of disciplined income generation. We have dissected the REIT, transforming it from a mere stock into a sophisticated, inflation-hedging, tax-advantaged income machine. You now recognize that the frantic spectacle of crypto hype cycles and the volatility of the Robinhood generation are simply sideshows, distractions from the quiet, powerful work of wealth accumulation. Your goal is not to win the daily lottery, but to own the essential infrastructure that makes the entire modern economy run: the data centers, the logistics hubs, and the stable residential properties. If you found value in this deep, cinematic breakdown of the Intelligent REIT Investor, if you feel the pull towards stability and disciplined income, make sure to subscribe to Capitura, because next we're covering a foundational book that will complete your investor toolkit. Our next deep dive will provide the ultimate psychological framework for maintaining the discipline necessary to implement Thomas's laws, teaching you how to defeat your own mind in pursuit of long-term financial freedom. Hit that subscribe button and ring the notification bell. Thank you for listening, and build your fortress with patience and purpose. The blueprint for safe income is not merely an introduction to the REIT structure. It is an economic dissertation on the nature of passive, institutional-grade cash flow. Brad Thomas meticulously establishes that the fundamental value of a REIT stems from its legal mandate to distribute at least 90% of its taxable income, a rule that structurally aligns the corporation with the investor's need for consistent income. This mandatory payout is the most significant differentiator from a typical growth stock, which can indefinitely reinvest earnings, often generating paper profits without ever rewarding shareholders with tangible cash. For the intelligent investor, the REIT offers a return profile where the dividend yield acts as a substantial portion of the total return, a reliable mechanism for capital preservation that stands in opposition to the zero-sum, high-variance game of speculative trading. Thomas delves into the economic durability of this income. He explains that real estate income is often secured by triple net NNN leases, particularly in sectors like industrial or necessity retail. A triple net lease places the responsibility for property taxes, insurance, and maintenance costs directly onto the tenant. This lease structure is the ultimate expression of the principle of simplicity in income generation. The REIT receives a nearly pure, predictable rent check, shielded from the volatile operational costs that plague traditional landlords. This reliable, predictable cash flow is precisely why REITs are invaluable for FIRE movement, providing a low-effort, high-quality stream of income that can reliably cover living expenses. The income generated by an NNN lease on a national pharmacy chain offers a financial certainty that no amount of crypto hype cycles or speculative option gambling can replicate. A crucial, often misunderstood element of the REIT blueprint is the concept of depreciation as a tax shield. Thomas clarifies that while accounting rules mandate depreciation, an annual deduction for the supposed loss of value of a property, real estate assets, particularly high-quality ones, often appreciate in real value over time. The depreciation charge, therefore, serves as a non-cash expense that significantly reduces the REIT's taxable income, which in turn allows a portion of the dividend distribution to be classified as return of capital, ROC. This ROC is tax-deferred, providing a temporary tax advantage that further enhances the after-tax quality of the income stream. The intelligent investor understands this mechanism, recognizing that the tax code is structurally favoring the REIT as a vehicle for long-term wealth accumulation and tax-efficient income generation. The structural resilience of the REIT is also paramount in mitigating the risks associated with global inflation waves. Thomas notes that the inherent tie to physical assets provides a natural hedge. As the cost of building materials, labor, and land rises, the replacement cost of existing properties increases, boosting their fundamental value. More importantly, the inclusion of rent escalators, annual rent increases built into the lease contracts, often tied to Consumer Price Index (CPI), ensures that the REIT's AFFO, adjusted funds from operations, grows in line with or even ahead of inflation. This contractual protection contrasts sharply with traditional fixed income investments, whose real value is systematically eroded by rising prices. The REIT investor, therefore, owns an asset that is structurally designed to thrive in an inflationary environment, a profound advantage in the modern economy fueled by massive fiscal and monetary expansion. Finally, Thomas addresses the critical function of liquidity in the blueprint. While traditional real estate is notoriously illiquid, the publicly traded nature of REITs, facilitated by zero-commission trading, grants instantaneous access to capital. This liquidity is not just a convenience. It is a vital component of the principle of risk. It allows the disciplined investor to adjust their exposure or exit position quickly without the massive friction and transaction costs of private market, especially during periods of market stress or sudden changes in personal circumstance. The ability to deploy capital quickly into a discounted REIT during a systemic panic, the ultimate opportunity, is only possible because of this underlying public liquidity. The REIT structure, therefore, is the perfect fusion of the tangible stability of real estate with the financial flexibility of the stock market. The debate over passive versus hyper-speculative behavior finds a fascinating angle in the REIT liquidity dynamic. Thomas would emphasize the difference between the illiquidity premium and the liquidity tax. Historically, private real estate offered an illiquidity premium, higher returns to compensate the investor for being locked into the asset. Publicly traded REITs give up this premium in exchange for liquidity, meaning they may trade at slightly lower returns than comparable private deals over the long term. However, the modern, high-speed market introduces a liquidity tax for speculative assets like meme stocks or certain crypto hype cycles, where the price is constantly hammered by rapid, emotional trading, often destroying capital. The REIT, by combining the stability of its underlying assets with manageable public liquidity, offers the best of both worlds: stability without excessive lockup risk, making a superior component for a FIRE-based asset allocation compared to either the highly illiquid private market or the highly volatile speculative public market. Brad Thomas's call to become a due diligence detective is a command to engage in active skepticism, an essential emotional discipline against the easy narratives of the market. This is the stage where the investor earns their returns by uncovering the often hidden flaws or undervalued strengths that are invisible to the passive investor or the algorithmic trader. The detective work must begin with a ruthless examination of corporate governance. Thomas stresses that the structure of the board of directors and the executive compensation plan are critical indicators of future performance. Are majority of the board members independent, bringing specialized, unbiased expertise, or is the board dominated by insiders? The intelligent investor looks for compensation structures tied to long-term metrics like AFFO per share, growth in total shareholder return over a 5-year period, not simply to short-term property acquisitions or stock price momentum. Any sign of excessive related party transactions or non-arm's length deals is a catastrophic violation of integrity and a signal to avoid the stock, regardless of how attractive the property portfolio may seem. The analysis of the property portfolio requires an advanced understanding of micro-market dynamics. Thomas would counsel the detective to look beyond the general sector, e.g. industrial, and drill down to the specific location. Are the properties clustered in primary gateway markets, New York, Los Angeles, key logistical ports, where the barrier to entry for new competition is extremely high, or are they scattered across tertiary markets where the risk of oversupply is significant? The value of real estate is profoundly local, and a fortress balance sheet combined with portfolio of irreplaceable, high-moat assets represents the zenith of the principle of value. This geographic rigor is what separates high-quality, long-term investments from speculative land plays. Furthermore, the detective must master the analysis of lease covenants and lease expiry schedules. The quality of REIT's future income is visible in its lease roll-up schedule. A large percentage of leases maturing in a single year, particularly in a cyclical sector like office or retail, present a massive refinancing risk and releasing risk. The intelligent investor favors a staggered, long-dated lease maturity schedule that smooths out income volatility and provides predictable cash flow decades into the future. The detective must also scrutinize the credit rating and financial health of the top 10 tenants, recognizing that a significant tenant bankruptcy can instantly impair AFFO and threaten the dividend, a real-world risk that cannot be mitigated by simple dollar-cost averaging. Thomas places unique emphasis on the dilution history of the REIT. REITs frequently issue new stock to raise capital for acquisitions. The intelligent investor must determine if this issuance is accretive or dilutive. An issuance is accretive if the cash raised is used to buy property that generates sufficient AFFO to more than compensate for the resulting increase in outstanding shares. A management team that consistently issues stock below its NAV or below its average P/AFFO is structurally destroying shareholder value through poor capital allocation, a profound violation of the trust granted to them. The detective must view capital allocation discipline as the most important indicator of long-term managerial integrity, separating the truly intelligent management from the opportunistic financial manipulators often lauded by financial influencers. In the 2020s, the due diligence detective must aggressively factor in the risk of technological obsolescence. For sectors like healthcare and industrial, the pace of change is accelerating. An older warehouse that cannot accommodate modern robotics, autonomous vehicles, or high-speed automation is rapidly losing value to newer, state-of-the-art facilities. Thomas would stress that the detective must audit the REIT's disclosed recurring capital expenditures, CapEx, against its property age and technological demands. A REIT that reports an artificially low AFFO payout ratio by underspending on CapEx is engaged in financial self-deception, creating a ticking time bomb of deferred maintenance and technological redundancy. The true fortress balance sheet is one that adequately funds maintenance and modernization, ensuring that the underlying assets remain relevant and competitive across multiple economic cycles, regardless of the noise from meme stock volatility. The mastery of valuation is the core intellectual engine of the intelligent REIT investor. Brad Thomas insists that this discipline requires the systematic rejection of common financial dogma and the embrace of specialized metrics that accurately reflect the economic reality of real estate cash flows. The deep analysis of AFFO, adjusted funds from operations, is paramount. Thomas stresses that the intelligent investor must understand why the market often focuses on the inferior FFO metric. FFO is simple to calculate and often results in a higher number, appealing to analysts who prioritize headline figures. However, by demanding the subtraction of recurring CapEx to arrive at AFFO, Thomas forces the investor to confront the non-deferrable cost of maintaining the revenue-generating capacity of the asset. The difference between FFO and AFFO is often the difference between a high-quality, safe dividend and a precarious, ultimately unsustainable payout. The AFFO payout ratio is the ultimate dividend safety indicator, with Thomas advocating for a wide buffer, retained earnings, which provides both a margin of safety during a downturn and the capital necessary for value-accretive growth, fulfilling the requirements of the principle of risk and the principle of discipline. Thomas would devote significant attention to practical challenges of NAV, net asset value, calculation in volatile markets. NAV is the theoretical private market value of the assets, and its comparison to the public stock price, price to NAV, provides a clear gauge of public sentiment. When the public price is at a significant discount to NAV, it suggests the market is pricing in either operational distress or severe macroeconomic fear, creating a massive opportunity for the disciplined buyer. However, the NAV calculation itself is an estimate reliant on subjective appraisal cap rates. The intelligent investor must apply conservative cap rates, the expected rate of return on the property, to the REIT's net operating income NOI, to ensure the NAV is not artificially inflated by overly optimistic projections. This internal, conservative valuation provides the anchor necessary to withstand the external volatility driven by AI-driven hedge funds and rapid-fire market panics. The final layer of valuation mastery is the use of dividend discount models, DDM, tailored for REITs. Thomas recognizes that since REITs are income vehicles, their long-term value should be modeled based on the present value of their future dividend streams. This DDM requires two critical inputs: the expected dividend growth rate linked to AFFO growth and lease escalators, and the required rate of return, the discount rate. This DDM approach is a pure application of the principle of value and the principle of time. It forces the investor to think in terms of decades of cash flow, completely ignoring the short-term noise of day trading psychology in the 2020s. By using a conservative discount rate, reflecting the inherent risk of the sector, and a realistic, sustainable AFFO growth rate, the investor arrives at an intrinsic value that is both durable and actionable. The key lesson in valuation mastery is recognizing that multiples are relative. AP/AFFO of 25 for a data center RT may be cheap if its long-term AFFO growth is projected at 8% annually due to durable contracts, while AP/AFFO of 15 for a cyclical retail RT may be expensive if its AFFO is stagnant or declining. The mastery lies in understanding the sector-specific risk premium and the certainty of the cash flow, leading to a disciplined investment choice that is fundamentally superior to the superficial comparison of simple P/E ratios. The global inflation waves have dramatically altered the P/AFFO premium. Thomas would argue that in an inflationary environment, the market should assign a significantly higher premium, a higher P/AFFO multiple, to REITs with demonstrably superior AFFO growth potential through CPI-linked leases and strong pricing power in high-demand sectors, e.g. cell towers, life sciences. This is because AFFO growth protects the real value of the cash flow. Conversely, REITs with flat or fixed-rate leases should trade at a lower P/AFFO, as their cash flow is effectively being eroded by inflation. The intelligent investor must, therefore, be willing to pay a higher price, P/AFFO, for a higher quality growth rate, G, as the long-term principal time will ultimately reward that choice through superior compounding and income safety for their fire-based asset allocation. Brad Thomas's perspective on the modern financial context is one of unwavering conservatism and profound skepticism regarding speculative trends. His analysis would be a systematic application of his timeless principles against the novel risks of the 21st century regarding the impact of AI-driven hedge funds and algorithmic trading. Thomas would stress that while these technologies have heightened market efficiency in pricing publicly available data, they have also created structural opportunities for the human investor. He would identify that algorithms excel at analyzing numerical data, AFFO debt ratios, but are blind to human capital allocation decisions and political risk. The human edge is found in anticipating regulatory shifts, e.g., changes to environmental laws impacting commercial property, assessing the long-term impact of management succession, and judging the real-world utility of a data center based on geopolitical trade flows, nuances that defy simple coding. This reinforces a need for the human due diligence detective to maintain a proprietary, non-algorithmic view of value. The phenomenon of financial TikTok and YouTube gurus promoting meme stock manipulation would be viewed as the apotheosis of behavioral failure. Thomas would articulate that these platforms monetize FOMO culture by turning investing into entertainment, violating the principle of discipline and the principle of simplicity. He would contrast the abstract, zero-utility nature of NFT madness and speculative tokens in crypto casinos with the tangible, income-producing reality of a REIT. The difference is the asset's inherent economic purpose. A warehouse moves goods, a hospital provides care, an apartment shelters people. These are economic necessities. An NFT is a digital receipt for an image, relying entirely on the next buyer's emotional willingness to overpay, a valuation thesis that the principle of value immediately rejects. Thomas would analyze the double-edged sword of cheap leverage through technology and global inflation waves. The ease of borrowing encouraged excessive risk-taking across all asset classes, inflating prices, including real estate. The resulting inflation and rate hikes, however, are the ultimate test. He would commend the fortress balance sheet managers who locked in low, long-term fixed rates, position them to thrive as inflation grows their rental income while their debt costs remain fixed. He would condemn the speculative players who relied on short-term floating rate debt, exposing them to catastrophic refinancing risk when the global inflation waves hit. This divergence proves the necessity of discipline over speculation. Comparing traditional strategies with modern hyperspeculation, Thomas offers a clear path: dollar-cost averaging DCA versus day trading psychology. DCA into high-quality REITs is the ultimate application of the principle of time and simplicity. It systematically acquires assets during market dips caused by the emotional gyrations of day trading psychology in the 2020s, guaranteeing the investor a reasonable cost basis over time. Attempting to trade REITs based on short-term price movements is a doomed endeavor, as the value driver, quarterly rent, is fundamentally slow-moving fire-based asset allocation and ETF dominance. Thomas would affirm that REITs are essential for fire-based asset allocation due to their growing income stream. However, he would caution against blindly relying on the largest ETF dominance. He would advise the investor to use fractional shares culture to build a focused, high-conviction portfolio of 2 or 3 smaller, internally managed REITs that are actively generating superior AFFO growth, thereby outperforming the passively managed index. This is the difference between settling for the market average and earning alpha through superior due diligence. Passive income security. Thomas's core lesson for the Robinhood generation is that financial security is a marathon, not a sprint. The consistent, growing dividend from a well-selected REIT provides a form of wealth that is psychologically stabilizing, allowing the investor to ignore the FOMO and leverage addiction that destroys the capital of those focused on chasing fleeting price gains. True wealth, he concludes, is the freedom to ignore the financial news. Thomas emphasizes the strategic financial advantages inherent in the blueprint, particularly the tax-advantaged nature of the dividend. The portion of the dividend shielded by depreciation, classified as return of capital ROC, offers a temporary tax deferral that maximizes the real spending power of the investor's income stream. This is not a short-term trick. It is a long-term benefit designed to encourage capital formation in the real estate sector. This structural advantage provides a powerful engine for the FIRE movement, allowing retirees to minimize their tax burden while living off the cash flow generated by high-quality assets. The blueprint's response to global inflation waves is perhaps its most compelling modern feature. Thomas provides a historical evidence. In inflationary periods, real estate has proven to be one of the most reliable inflation hedges. This defense mechanism operates on 2 fronts. The asset value, the cost of replacing the buildings rises, and the income stream, rents are reset higher. The intelligent investor actively seeks REITs with short lease cycles, e.g., apartments, self-storage, or, more reliably, long-term leases with explicit CPI-linked escalators. These escalators guarantee that the AFFO growth keeps pace with the rising cost of living, protecting the investor's purchasing power with a contractual certainty that passively held fixed-income assets cannot offer. Crucially, Thomas contrasts the REIT blueprint with the psychological vulnerabilities of direct real estate ownership and speculative trading. Direct ownership subject the individual to the 3 T's: tenants, toilets, and termites, high operational friction, and massive illiquidity. Speculative trading, particularly with cheap leverage through technology, subjects the individual to the emotional contagion of FOMO culture and the catastrophic risk of liquidation. The publicly traded REIT, facilitated by zero-commission trading, offers the ideal synthesis: professional management, diversification, inflation-protected income, and instantaneous liquidity. This structural simplicity allows the individual investor to implement their FIRE-based asset allocation without violating the principle of simplicity or the principle of risk. The blueprint is, in essence, the ultimate financial tool for those who prioritize security and stability over the chaos of the high-velocity market. Modern investing reflection: the income certainty premium. In a world where market returns are increasingly abstract and fueled by high PE multiples on unproven promises, Thomas would argue that income certainty is the most valuable premium. The market frequently undervalues the predictability of a contractual cash flow. The intelligent investor should recognize that a REIT with a high-quality fortress balance sheet and long, secured leases should trade at a premium relative to its growth rate, simply because the risk associated with its cash flow is profoundly lower. This low-volatility cash flow is essential for retirees, and those rely on their portfolio, allowing them to withstand the massive drawdowns that affect highly speculative growth stocks without having to sell assets at a loss. The ultimate modern lesson of the blueprint is that stability is the new alpha. The deep dive into management quality goes beyond simple bio reading. Thomas insists on studying executive compensation disclosure like a financial anthropologist. Is the CEO's bonus tied to AFFO per share growth over a 3 to 5 year period, rewarding sustainable, long-term performance? Or is it tied to short-term metrics like total assets acquired or funds raised, which incentivize reckless expansion and dilution of existing shareholders? The detective must view any compensation plan that encourages short-termism as a fundamental flaw in the principle of discipline. Furthermore, the preferred status of the internally managed REIT is non-negotiable, eliminating the inherent conflict of interest where an external manager profits from complexity and size, regardless of per share performance. The scrutiny of the property portfolio must incorporate advanced market forecasting. Thomas guides a detective to analyze not just the current use of the property, but its adaptability and highest and best use potential. An old retail box, for example, may have low current value, but its large, well-located land parcel may offer immense embedded value if rezoned for high-density residential or industrial use. The detective looks for this embedded option value, the hidden asset potential that the public market, often focused on the property's current failing use, frequently overlooks. This qualitative, contrarian assessment of land value is a powerful opportunity generator. The detailed analysis of tenant credit risk must utilize external, institutional-grade data. Thomas would advise the detective to analyze the weighted average lease term WALT and cross-reference the tenant's credit ratings S&P Moody's. The WALT should be long, ideally 5+ years, to smooth out income volatility and provide reliable cash flow visibility. Crucially, the detective must model the impact of the top 10 tenant exposure. A REIT with 30% of its income derived from a single, slightly shaky tenant is a massive violation of the principle of risk, making the entire portfolio vulnerable to that single operational failure. This detailed, probability-based analysis ensures the dividend safety required by the FIRE-based asset allocation. Finally, Thomas highlights the detective's role in assessing CapEx and technological obsolescence. The investor must look beyond a generic maintenance label and audit the spending against sector demands. For a multifamily residential REIT, adequate CapEx means continuous investment in smart home technology and modern amenities to justify rising rents. For a logistics REIT, it means ensuring facilities can handle high-throughput automation and extreme weight loads. A REIT that lags technologically is not just losing tenants. It is fundamentally losing value, a slow, corrosive process invisible to the speculative trader chasing Tesla hype. The detective ensures that the fortress balance sheet is not only funded, but is actively allocating capital to preserve the long-term utility of the assets. The modern market is defined by algorithmic filtering driven by AI-driven hedge funds. These systems rapidly scan for low P/FFO ratios, high yields, or debt metrics outside normal ranges. Thomas would advise the human detective to use this filtering as a guide for contrarian opportunity. When an algorithm flags a REIT for a temporary dip in AFFO due to a specific one-time event, e.g., a planned temporary vacancy for a major renovation, the algorithm sells indiscriminately. The human detective, armed with discipline and the specific knowledge of the renovation's long-term accretive nature, recognizes the market error and seizes the high conviction buy. This is the ultimate competitive edge for the intelligent investor against the machine, the ability to differentiate transient noise from permanent value impairment. The mastery of valuation is the mathematical and conceptual core of Brad Thomas's framework, demanding a complete intellectual divorce from the speculative metrics that define the modern market. This chapter elevates the analysis of REITs to an academic rigor suitable for institutional capital allocation. The definitive metric, adjusted funds from operations, AFFO, is stressed as a cash flow reality check. Thomas dissects the inherent flaw of FFO, the lack of subtracting recurring capex, by emphasizing the concept of economic depreciation. While accounting depreciation is non-cash, economic depreciation, the actual wear and tear, must be covered by real cash. AFFO ensures this necessary cash expenditure is factored in, providing the truest measure of the cash flow available for distribution and sustainable growth. The AFFO payout ratio is thus not just a ratio. It is a measure of managerial honesty. A ratio consistently pushed to 95% or higher is a clear signal that management is prioritizing a high headline yield over the long-term health of the fortress balance sheet. The advanced use of net asset value, NAV, is critical. Thomas instructs the investor to use NAV not as a simple liquidation number, but as an intrinsic value anchor. The intelligent investor calculates their own conservative NAV using realistic cap rates, a crucial step in a market distorted by cheap leverage through technology and artificially low returns. When the stock trades at a deep, sustained discount to this conservative NAV, it creates an enormous margin of safety, a concept championed by Ben Graham and fully embraced by Thomas. This margin of safety provides a crucial buffer against unforeseen market shocks, a necessary defense against the systemic risks amplified by global inflation waves. The integration of the dividend discount model, DDM, is the final, most sophisticated valuation tool. Thomas guides the investor to use the DDM as a tool for long-term price target setting. The calculation requires a realistic, sustainable dividend growth rate, G, derived from AFFO growth and projected rent escalators, and a prudently chosen required rate of return, R. The ultimate output is an intrinsic price target based on the principle of time, which is impervious to the daily noise of day trading psychology. This valuation framework ensures that the investor's decision to buy, hold, or sell is rooted in the quantified value of decades of future cash flow, not the ephemeral momentum of the market. Thomas would also analyze the danger of multiple expansion contraction. Many highly valued REITs in the technology space, e.g. data centers, trade at high P/AFFO multiples, e.g. 25-30x. The intelligent investor must recognize that even if the AFFO growth remains strong, a contraction of that multiple to a historical average, e.g. 20x, can wipe out all capital appreciation over several years. Valuation mastery requires modeling this multiple risk, ensuring that the entry price provides a sufficient discount to the asset's intrinsic value to absorb a potential P/AFFO contraction without resulting in a loss of capital. The valuation paradigm must incorporate an inflation/deflation toggle. In the current environment of high global inflation waves, valuation favors short lease, high pricing power REITs, apartments, self-storage, and assets with CPI-linked escalators, rewarding their capacity to grow AFFO rapidly. However, Thomas warns of the risk of an eventual deflationary cycle. In deflation long-term, fixed-rate leases on essential high-credit properties, e.g. healthcare logistics, become more valuable as the fixed income stream increases in real purchasing power. The intelligent investor's valuation model must stress test the portfolio against both scenarios, ensuring the asset mix provides resilience regardless of which economic reality prevails, transforming risk into a controlled, probabilistic outcome. Brad Thomas's ultimate commentary on the modern financial age will be a comprehensive synthesis of his 6 principles, applied as a stabilizing force against pervasive volatility. He would assert that the defining characteristic of the 2020s is the instantaneous amplification of human behavioral flaws by technology. Thomas would recognize that AI-driven hedge funds and algorithmic trading have fundamentally changed the nature of opportunity. The quant systems, designed to exploit market micro-efficiencies, have forced the human investor to seek opportunities in structural market flaws and behavioral anomalies. This means buy into fear amplified by social media financial panic cycles, and selling into euphoria fueled by irrational exuberance Tesla hype, rely entirely on the discipline to withstand the emotional pull of the herd. The intelligent investor uses ETF dominance to track where the passive money is flowing and then exploits the adjacent, undervalued mid-cap REITs that are ignored by the index mandate. The critique of financial TikTok and YouTube gurus would be unsparing. Thomas would highlight that the pervasive promotion of option gambling and meme stock manipulation is an attack on the integrity of the principle of discipline. He would contrast the abstract and proven speculation of crypto casinos and NFT madness with the foundation necessity of property. Every digital transaction relies on a tangible data center owned by a REIT. This comparison provides a clear moral and economic distinction between a productive, wealth-creating asset, the REIT, and a zero-sum, speculative commodity, the token. The structural challenge of leverage addiction facilitated by cheap leverage through technology will be analyzed through the lens of the fortress balance sheet. Thomas would note that the proliferation of low-interest debt across the economy inflated the price of all assets, but only the conservatively leveraged REITs are prepared for the necessary deleveraging phase triggered by global inflation waves. He would advise, use fractional shares culture to build a highly diversified, low-leverage REIT portfolio, ensuring that no single asset failure, amplified by debt, can cripple the overall fire-based asset allocation. Thomas's final message would center on the distinction between the passive default and the active discipline. While dollar cost averaging into a broad REIT ETF adheres to the principle of simplicity and time, the highest, safest returns are reserved for the intelligent investor who applies active due diligence. This active approach means calculating conservative AFFO and NAV, scrutinizing management compensation, and positioning the portfolio based on sector rotation aligned with the economic cycle. The successful investor is the one who marries the liquidity and accessibility of the modern market with the timeless, unyielding discipline of fundamental real estate analysis. The conclusion of the intelligent REIT investor is not an ending, but an empowering commencement. Brad Thomas has equipped the individual with the toolkit of the institutional investor, providing the clarity necessary to navigate the most chaotic financial environment in history. The enduring lesson is that stability, resilience, and income are the ultimate currencies of financial freedom. The core realization is that the 6 laws of REIT investing are, at their heart, the laws of conservative capitalism and self-mastery. They are the essential countermeasures against the psychological pitfalls amplified by the digital age. Here are 10 timeless principles distilled from Brad Thomas's ultimate framework, synthesized for the modern investor. Income is the economic shield. Prioritize the AFFO-driven income stream as a primary source of total return. This income, protected by durable leases and inflation escalators, is the economic shield that allows the investor to withstand market drawdowns without selling valuable assets. Ensuring success of any fire-based asset allocation at NAV is an intrinsic anchor. Calculate your own conservative net asset value, NAV, to establish the true intrinsic worth of the asset. Only buy when the stock price offers a substantial discount to this anchor, thereby creating a vital margin of safety against unforeseen risk. Liquidity as strategic optionality. Value the public liquidity of the REIT structure. This liquidity is not for frantic trading, but for the discipline of being able to exit poor investments or seize massive opportunities during systemic market panics, e.g., flash crashes caused by algorithmic trading. Embrace inflationary pricing power. Strategically select sectors and properties with contractual CPI-linked rent escalators or short lease cycles. This ensures that the REIT acts as a true inflation hedge, protecting capital from the corrosive effects of global inflation waves. Debt management is solvency. Treat the fortress balance sheet as the non-negotiable insurance policy. Focus on low debt-to-EBITDA, high fixed charge coverage, and the strategic laddering of debt maturities to eliminate refinancing risk amplified by rising rates. The superiority of simplicity. Reject overly complex derivatives, multi-factor models, or low-conviction positions encouraged by fractional shares culture. The most robust strategy is a simple, high-conviction ownership of a few deeply understood, high-quality assets, adhering to the principle of simplicity. Contrarian behavior is alpha. Use the emotional overreactions of the market, fueled by FOMO culture and social media financial panic cycles, as your source of alpha. Buy when the sector narrative is most painful. Trust in the principle of value over the collective fear of the herd. Management alignment is due diligence. The quality of the board and the structure of executive compensation, tied to long-term AFFO growth and share price, are the ultimate indicators of asset protection. Poor governance violates the principle of discipline and is a terminal risk. Time defeats volatility. The principle of time ensures that volatility is irrelevant to the long-term compounding of cash flow. Be patient. Let the dividend reinvestment work its geometric magic, systematically acquiring assets during market dips and outlasting the speculators consumed by the speed of day trading psychology. Productivity over speculation. Recognize that the REIT is a share in productive, necessary enterprise, logistics, healthcare data. Your income is derived from real economic activity, a morally and economically superior source of wealth, compared to the zero-sum speculation of crypto casinos or meme stock manipulation. Deliver deep, powerful closing thoughts. By applying the rigor of Brad Thomas, the investor steps off the volatile roller coaster hype and anchors their future in a reliable, growing cash flow of the real world. The journey through Brad Thomas's The Intelligent REIT Investor is now complete. You have gained not just knowledge of financial vehicle, but profound understanding of the mindset required to build generational wealth, a mind anchored to the tangible and immunized against the temptations of the abstract. You have learned to transform chaos into opportunity, to see global inflation waves not as a threat, but as a catalyst for AFFO growth, and to view the speculative noise of the modern market as a source of discounted assets. Your new portfolio philosophy is one of resilience, safety, and unwavering focus on the income stream. If this deep, cinematic breakdown of the ultimate real estate investing blueprint resonated with your pursuit of durable financial freedom, it provided the clarity you needed to reject the volatility and embrace the stability, make sure to subscribe to Capitura. Our commitment is to deliver the most comprehensive, educational, and transformative financial content available. Next, we are taking on the psychological foundation of all financial success, exploring the timeless wisdom necessary to cultivate the emotional discipline required to fully execute Thomas's laws in the face of modern temptations. Don't miss the final piece of your investor armor. Hit that subscribe button and ring the notification bell. Thank you for listening, and go forth and build your fortress of income